Hello and welcome to Streetwise Live. I'm Cindy Edwards. Today we're talking royalty companies and why they might be something to explore when you're adding to your investment portfolio. Before we do that, please take a look at our disclosure statement, and it's a long one, so feel free to replay this show over and over again so you can read it in its entirety. And while you're at that, why not hit the subscribe button below? There you go. All right, there are a number of ways to invest in precious metals, and one way is to invest in individual companies. Another way is to invest in a royalty company, and that way you gain exposure to a variety of companies and lessen your risk. Now, royalty companies have been around since about 1983, and so far they've outperformed most commodity-based benchmarks. Joining us now are Kyle Floyd, CEO of Vox Royalty, David Talbot, Managing Director, Equity Research at Red Cloud Securities, and Spencer Cole, Executive Vice President of Vox Royalty. Hi, gentlemen.
Hi, Cindy. Thanks for having us.
Hi, Cindy.
Our pleasure. Hey, Kyle, I want to start with you. Tell us a little bit about the history of Vox Royalty.
Yeah, thanks, Cindy. Vox Royalty Corp was created to be a better risk-adjusted opportunity for investors to get exposure to the commodity sector. And we've built a company with very significant competitive advantages for this industry and for the mission of driving truly accretive growth for our shareholders. And we continue to build on that mission.
And for people who are not familiar with royalty companies, can you explain how they work?
Sure. Royalty companies essentially take an interest in the top line revenue generated by a mining asset. So we're not the operators of these mining assets, and we buy third-party royalties. So royalties held in the hands of third parties, again, not the companies actually operating these mines and putting in a lot of that hard work. We're looking for interests that lie in these third parties that have the underlying revenue interest in these mining operations.
All right, Spencer, you're up next. Vox Royalty, as Kyle mentioned, doesn't finance mining companies. You find the third-party royalties around the world. Can you explain to us how you do that?
Absolutely, Cindy. So the most common way that a royalty is created is when somebody makes a discovery, either a prospector or often a junior exploration company, but they don't have the $100 or $200 million to actually build the mine. So they sell those mining claims or that project to a larger mining company, and in return, they get a royalty contract that gives them, say, 1 or 2% of future revenue from that potential mine. So what we do is we contact that original prospector or the exploration company that made the discovery, and then we make them a fair offer for their royalty investment.
All right. Now, you've bought royalties for one company. It was an iron ore company. You bought that from a telecom company. You bought royalties for a gold company from a hearing aid company, and you got more gold royalties from an automotive company. How do you find those companies, and what's their motivation to sell those to you?
Sure. So they are a bit weird and wonderful, I must admit. They're not your typical holders of mining royalties or investments. Each of those companies were historical mining exploration companies, and then their listed entity was then hollowed out as a shell company for a non-mining business. The way we're able to find completely forgotten royalties like that is through our proprietary royalty database. Over the past 10 years, Vox has built what we believe is the world's largest proprietary royalty database, which now is approaching almost 8,000 hard rock mining royalties. So we use that proprietary royalty database to identify forgotten and sort of hidden gems royalties like that.
Okay. Now, David Talbot from Red Cloud Securities, give us your thoughts on royalty companies in general, first of all.
Thank you, Cindy. Royalty companies, they've been around since the mid-1980s, as you said. I even worked for the original Franco-Nevada for 6.5 years in the 90s. And these companies have typically outperformed most commodity-based benchmarks. And that's what makes these companies really attractive. As was mentioned before, royalty is a contract that gives holders a right to a portion of the final mixed product. So, these royalty companies can either create that contract and provide that upfront sum. They can help finance a counterparty doing that, or they can be purchased from third parties. So, royalties, as was mentioned earlier, was a way for prospectors and project developers to sort of reap the benefits of their own work and gain exposure to the asset over the long term. But what you find is they'd like to monetize those royalty assets for cash or shares. And this is where royalty companies come in. It really puts together the company puts together diversified portfolios of royalties. They're expected to become cash flowing in the future. And the thing we like about the royalties is that there's limited downside. There's less direct exposure to risks of operating companies. They're not directly impacted by operating or capital costs or margins. They're not subject to cash calls to fund exploration or development, and they can provide exposure through the entire commodity cycle. So you can look for some upside during higher prices, during resource expansions, production growth, new discoveries, and ultimately it's just a very efficient business model. Corporate G&A costs are typically low because you don't need a large operating or management team required for these companies.
Well, taking a look at what analysts are saying, including your company, you're saying this is a buy rating. Your price target is $5.40 Canadian for this. It's currently getting close to about $3.40. Let's see, we've got Cantor Fitzgerald put something out yesterday. They say this is a strong buy, and their target for the year is $4. The stock has gone up about almost 12% in the last 5 days. And then we've got the chart guru, Clive Mond, just put out a statement, and we'll bring that up. Given how depressed the precious metal sector has been in recent months, Vox has held up well, and so it doesn't take much imagination to figure how it will likely perform if the sector takes off higher soon, which is a growing probability with commodities set to rise in the face of massive money creation. We therefore stay long, and Vox is rated an immediate buy ahead of the expected breakout from the large Head and Shoulders bottom that looks set to occur soon. Interesting. Kyle, that must be music to your ears hearing all this.
Yes, we've worked very hard to create accretive value for our shareholders. We both we lead the industry in terms of acquisitions, but we also have created a royalty portfolio that what we call organically is creating value for our shareholders. So we recently announced 8 updates from 8 different operating counterparties that run these mining operations, that their investment and their progress on these underlying mining operations increases the value of our royalty portfolio and hence also the value to our shareholders. So we've worked very hard to build the business that we have today, but we have a lot in front of us as well.
Of course, for everybody who's watching right now, you're welcome to submit your questions so that we can ask these guys, because you've got them here now. So if you have any questions about Vox Royalty, feel free to put those down and we'll read them out. David, what should investors be looking for when they're researching these royalty companies? What do they have to look out for?
Yeah, thank you, Cindy. When researching royalty companies, there are quite a few things to consider. First of all, commodity mix. This could be due to preference or diversification. Obviously, jurisdiction might help reduce risk as well. Knowing who your property owners are, your operating partners are, because the royalty companies really have no say on how the operations are run. And then you should also know what you're buying, because not all royalties are created equal. The royalty may or may not cover the entire deposit, and it's important to know what kind of royalty you're buying. NSRs, NPIs, WIs, gross overriding, sliding scale, etc. Most of them are life of mine, but sometimes there are caps on that. And the kind of royalty is important because a 5% net profit interest or working interest royalty typically isn't worth as much as, say, a 5% stream, and neither are worth as much as a 5% NSR. So, sometimes it comes down to the underlying costs associated with that royalty. And then I'd say probably organic growth is likely the key. Investors right now are buying cash flow, but future cash flow is probably more important. And this comes down to the ability of management to recognize the good assets. Companies such as Franco-Nevada or Cisco Royalties, they can really afford to buy or create royalties or streams on advanced projects or producing mines. But for most junior companies, whether they create create royalties, or they buy third-party royalties, much like Vox does, you'd like to see them come in a little earlier and build a basket of assets, essentially royalties that wouldn't yet have reached their intrinsic value. So, essentially for deep value creation, you want to see a pipeline of exploration and development royalties grow into a broad, diversified portfolio of cash flowing assets. And for those good quality assets, any future resource estimates, production increases, discoveries can certainly help expand the life of that cash flow at no further cost. And, just right now, we do have good markets. High commodity prices mean existing royalties are paying more right now, and the active equity market that we have ensures that many companies are funded to advance and de-risk those projects. But it is a competitive market, so royalties must just ensure they don't overpay.
Yeah, Spencer, you're not the only royalty company in town. So how do you differentiate yourself from the competition?
Yeah, absolutely, Cindy. So two key areas where we differentiate ourselves from the competition. The first is having true defensible intellectual property. So as I mentioned before, we've spent the better part of the last 10 years building a royalty database that's approaching 8,000 hard rock mining royalties. So that just gives us a huge edge in identifying hidden and forgotten royalties. The second key advantage and differentiator with the Vox team is our management team is a technically focused group of mining engineers and geologists who've worked all around the world for some of the who's who of mining companies, from BHP to Rio Tinto to Gold Fields, Rand Gold. Our technical team has worked on every major mining continent and across all the key deposit types that we constantly look at. Because the key with evaluating new royalty opportunities is obviously not to fall in love with the asset, because then you're going to overpay for it, but really getting towards the true understanding of where the value and the key risks lie for that royalty. So we have so many opportunities that we're looking at that we're in a fortunate position where we can say no, or we can pass on more royalty opportunities than anyone in the industry. So it ensures that when we do make an investment, and we obviously make a lot of investments, we've done 19 separate deals in the past 2 years. When we do allocate capital for our investors, it's in a very technically informed way where the risk-adjusted returns are maximized for our investors.
Kyle, you're involved primarily in precious metal royalties, but that is not all. So what else have you dipped your toes into?
Yeah, well, we've looked at Franco-Nevada as the model. David mentioned that he worked with Franco-Nevada back in the very early days, and they've created a tremendous amount of shareholder value. And Franco really stood by the model that about 70% of their portfolio to 80% of their portfolio would be precious metals, and there would be a nice basket of others and that basket of others for them was hydrocarbons. We don't do hydrocarbons, but that provides really nice diversification of risk further in the portfolio, and in turn, a lower risk premium on that future cash flow. And so we subscribe to the same model. And what we look for is really deep value and great opportunities with great assets to get royalties over those assets, whether that's in near-term production vanadium or copper. We found really interesting royalties over some of those assets underpinned by those commodities that we think really adds value to our investors to have some exposure to those commodities within the portfolio.
Okay, Spencer, where are most of your royalty companies located that you have? And tell us about your technical team and why that team is so important for your acquisitions.
Absolutely, Cindy. So our portfolio of 47 royalties has been constructed very thoughtfully and meaningfully towards low geopolitical risk jurisdictions. So 80% of our royalties are located in Australia, Canada, and the United States. So that presents, optimal risk-adjusted returns for our investors. We've got a really great first mover advantage in the Australian market. So as was mentioned before, we're the second largest holder of royalties in Australia, second only to Franco-Nevada, which being second to a $27 billion company isn't such a bad thing. And then I guess how our technical team overlays on that. When we look at new royalty opportunities, particularly in the Australian market, what we're really looking for is obviously what's the price for this royalty up front, But then as important as the upfront price is, what are the growth catalysts for this asset? How many meters are being drilled by the operator? When is the feasibility study due out on this underlying royalty asset? And ultimately, when is this going to be brought into production so that our investors can get the benefit of the cash flow from this royalty? So our technical team focuses as much on what is the upfront value and what should we pay for the royalty as focused on what are the near-term catalysts that will continue to add organic growth and value to this royalty investment for our shareholders.
And Spencer 7 asks, do you have uranium royalties?
Yeah, it's a good question. We do not have uranium royalties. In the past, we've looked at a number of uranium royalties, but I think our preference is to stay focused on a core suite of commodities where we have deep technical expertise and we believe in the medium to long-term fundamentals of those commodity groups. So we're much more comfortable at home in precious metals and base metals, particularly. I don't think we'll be buying any uranium royalties anytime soon.
Okay, Kyle, let's talk about your revenue growth outlook for this year in particular. How are things coming along?
Things are coming along very well. Analysts have us going at about a $2 million run rate as we end this year, growing organically to around $6 million, the following year to $8 million. What I would tell you is between organic growth and also acquisitional growth, we expect that those numbers will end up being exceeded, and that hockey stick or that exponential growth in revenue is going to continue really at this point, as far as the eye can see from our perspective, as we continue to have acquisitions and organic growth, where we're seeing assets come into production and further assets acquired that are already in production.
And for people who are sitting on the fence, why should they invest in Vox today rather than just waiting to see what happens?
Yeah, it's a very good question, Cindy. The reality is, I think the market is waking up to what we're doing in the royalty sector. I would say we're a little bit of a disruptor in the space with our competitive advantages, especially in terms of intellectual property and deal sourcing agents that we have around the world that help us uncover great value in the royalty sector. And so we're gaining critical mass by the day, both in terms of overall portfolio, in terms of current and future expected cash flow growth. And at some point, I think the market is going to see the opportunity that exists within Vox. We trade at a discount to our peers. We believe our business model at the end of the day will warrant a premium valuation in this sector. So that's all essentially very significant upside to our investors beyond just the tangible accretive growth that we generate day by day.
David, what is it specifically about Vox Royalty that you like?
Well, we like this company and we like the management. And as you pointed out, Red Cloud Securities has a buy 540 target price on the stock. They have an experienced team. They're not going to overpay for assets. And I'll get back to that in just a moment. But, they're focused on third-party assets, and that helps reduce cost, risk, even management time it takes to find these things. So the company is very active. Right now it has 74 royalties and streams, and we expect continuous deal flow as it builds out its pipeline of royalties. They have a good mix of precious metals, base and other metals, a broad diversification of risk across operations, commodities, and low-risk jurisdictions. And, the quality of their partners is improving. And like I said before, that's important here. So, we expect a lot of catalysts here. There is significant organic growth as their assets mature towards production. From one paying a royalty that's now turned into 4, they're on their way to 6 by year end. So we see that organic growth. And, I think this proprietary database that contains, like they said, 8,000 royalties, that's very important here. Many of those are obscure, therefore they should have little competition to acquire. And that helps Vox with their edge. It allows them to be very opportunistic. And lately we've seen the company acquire royalties around the 0.3, 0.4 times NAV area, whereas, sometimes vendors don't even know they have them. And then peers typically are buying similar stage royalties around 0.7 to 1 times NAV. So, finally, what makes this a good investment is its current valuation. It is trading at a discount. It's trading at about 0.9 times NAV versus peers that typically are trading closer to 1.2 times NAV. And if you look at, say, a 2023 EBITDA, it's trading at about 25 times versus peers at 40 times. And really, this is a function of Vox being the emerging cash flow vehicle. And, as we mentioned, as they go to 6 royalties this year and several more a couple of years out from now, as the company grows, I think this valuation gap will really shrink.
Sounds very positive. All right, Spencer, let's talk about the acquisition of some royalties in Western Australia and why that's significant.
Sure, Cindy. So about a week ago, we announced the transaction to acquire an additional portfolio of 3 gold royalties in Western Australia, as you mentioned. This brings our total royalty portfolio in Western Australia specifically to 25. We view Western Australia as the #1 mining jurisdiction, particularly for gold mines. Whether you're exploring, developing, or operating a gold mine, we think Western Australia is one of the safest and most stable operating jurisdictions on the planet. So we really like the fundamentals of the state from a fiscal perspective. We love the geology. The Greenstone Belt there is hugely prolific. It's produced a lot of gold and a lot more to come. And then I guess from a strategic perspective, we have one of our key executives, Rian, who's a renowned geologist. He's permanently based in Perth. And within our royalty database also, approximately 20% of our database is over Australian assets. So we have the right sourcing edge to continue to grow our portfolio in Western Australia. We love the geology. It's a stable operating regime. They've had less than 1,000 COVID cases in total. So it's fairly business as usual there from a COVID perspective. So for all those reasons, we have historically grown and will continue to grow our portfolio in Western Australia.
Yeah, Kyle, how has the pandemic affected business, or has it? And are you seeing a big change right now?
Yeah, we're in a fortunate position that we have not been tremendously affected by the pandemic. We're obviously very empathetic for the businesses and the people that have been. But in terms of Vox's core business, it actually has not had much of an effect. In fact, with so many of our assets in Western Australia, where they've had very, very low relative COVID cases, most of the mining industry has continued on as normal. And so we've been relatively not impacted by the pandemic, which we're very thankful for.
Let's talk short-term goals for Vox first of all. Kyle, you want that?
Sure. On a short-term basis, we're excited about what we're delivering for investors. We told investors we are going to deliver organic growth. It's probably one of the hallmarks that we kind of hang our hat on, is that we're finding assets that are going to deliver value over the long term for our shareholders, and we continue to do that. From an acquisitional standpoint, our competitive advantages continue to bring new royalty opportunities at ever-increasing velocity, and we believe we are seeing more royalty opportunities than anybody else in the sector, and that provides very significant advantages for our shareholders in that we have the opportunity to really pick the assets that we want in the portfolio, and being very disciplined in terms of what we acquire. And so short term, both from an acquisition standpoint and organic growth, we're ahead of schedule and excited about where we're at.
And Spencer, would you like to give us an outlook for the long-term goal for Vox?
Well, I think, Cindy, as Kyle touched on, long term, it's just continuing to execute on the differentiated strategy that we have. And we have full confidence as management that the market will continue to price, all of that potential into our stock. So, it sounds like a bit of a cop out of an answer, but it's a lot of just what we're already doing, and then having the patience to continue having a disciplined allocation of capital as we continue to do, and then the market will respond in due course.
And David, is there? Oh, go ahead, Kyle.
And I would add to that, Cindy. I think one of the I think key opportunities that's going to be enlightened to the market and frankly to the world over the next 5 to 10 years. Mining royalty assets are going to be, we believe, one of the scarcest commodity assets in the space. And we have an edge in terms of finding and sourcing these royalty opportunities over essentially, if not everybody, mostly everybody in the space. And when you look at the scarcity that's going to develop and the replacement rate of new royalties being formed, it's not enough to basically replace what's being acquired in the industry. And so over the next 5 to 10 years, this portfolio, in terms of just the sheer scarcity of assets in this space, should continue to perform very, very well.
And David, for investors who are watching right now, who are just hearing about royalty companies for the first time, what advice do you have for them? Should they look at it every day? Should they just buy and hold? Should they think of this as a long-term investment? What are your thoughts on that?
Yeah, I would say this is more of a long-term investment. You are actually buying not necessarily for today's ebb and flow in commodity prices. You're buying for tomorrow's. You're buying for the organic growth in these companies, and really you're buying the management teams. Their ability to take these opportunities and essentially put them in their own portfolio and let them, it's almost like a mutual fund. Let them deal with the several diversification or the pipeline of projects. And, in fact, once they're actually in the company, there's very little to do except follow and count the money as that comes. So I'd say this is a long-term investment.
And Kyle, as a fairly young, well, not a young company, you've been around for a while, but you've only been public for a matter of 7 months now?
About 10, but yeah,
10 months?
Relatively new on the public scene.
So the goal, I'm sure, is to get your name out there and to get everybody to know who you are. And I know that you've done a really nice job putting a video together, and I want to run that now. And it just kind of gives an overview of what Vox is all about, right?
It does. It encapsulates that we are on a worldwide search for the best royalty assets on the planet, and we're bringing those and surfacing those for our investors. And we're excited to bring that type of portfolio as we continue to build for our shareholders.
Okay, how about we take a look at that video? That was beautifully done. Nicely done indeed. Kyle, I'm going to let you have the last word before we sign off for today.
Well, thank you, Cindy, and to the Streetwise team, and also David for joining us. It was a pleasure to be with you. We're excited about what Vox Royalty is building for our shareholders. We hope you found the Streetwise live event informative and full of background on who Vox is and what we're accomplishing for our shareholders, and hope to have you as part of the journey with us. So thank you.
Okay, Kyle Floyd, CEO of Vox Royalty, David Talbot, Managing Director, Equity Research at Red Cloud Securities, and Spencer Cole, Executive Vice President of Vox Royalty. It's been a pleasure. Thank you all very much for joining us today. Before you go, don't forget to hit the subscribe button below. We love interacting with you during each show. We want you to be proactive rather than reactive investors. And if you know of a public company that you would like featured on the show, please get in touch by going to live@streetwisereports.com.